Hello. Welcome to JKO News, where you get more facts and less opinions. This is the Week in Review, for the week of 30th of January to the 3rd of February 2023. It was a busy week in the economic and financial fronts, hence this report is a bit longer than usual. Tensions in Iran. Iran said one of its ammunition depots was attacked in a drone strike. This happened while U.S. Secretary of State Antony Blinken visited Israel. It's not known who was behind the strike near the central city of Isfahan late Saturday, and there's been no official statement by Iran casting blame. But Tehran has often pointed the finger at Israel for similar incidents in the past. The Wall Street Journal reported past Sunday that Israel was responsible, citing unnamed U.S. officials and people familiar with the operation. The aim was to look for new ways to contain Tehran's nuclear and military ambitions. The U.S. and Israel are in agreement that Iran must not have nuclear weapons and are working together to counter the nation's influence in the region. Blinken said, quote, "We discussed deepening cooperation to confront and counter Iran's destabilizing activities." World Health Organization and nuclear emergencies. On the 27th of January 2023, the World Health Organization, WHO, updated its list of medicines that should be stockpiled for radiological and nuclear emergencies, along with policy advice for their appropriate management. These stockpiles include medicines that either prevent or reduce exposure to radiation, or treat injuries once exposure has occurred. Dr. Maria Nera, WHO Assistant Director General, said, quote, "In radiation emergencies, people may be exposed to radiation at doses ranging from negligible to life-threatening. Governments need to make treatments available for those in need, fast. It is essential that governments are prepared to protect the health of populations and respond immediately to emergencies. This includes having ready supplies of life-saving medicines that will reduce risks and treat injuries from radiation." End of quote. Is the UK heading into a recession? This week the International Monetary Fund, IMF, became UK's public enemy number one for saying the UK will be the only rich economy to suffer a contraction in 2023. The BOE suspects the UK is headed for a 15-month-long recession, culminating in a 0.5% contraction this year and 0.25% next year. IMF forecasters predict 0.6% will be wiped off UK GDP this year, but most of that is on track to be recovered in 2024 when the economy grows nearly 1%. Adani Industries slump. Gautam Adani, India's top billionaire, had a good start of the year when he announced a follow-on public offer to raise capital from the Indian stock market. Troubles started mounting soon after a New York-based investment research firm by the name of Hindenburg Research published a report accusing Adani of potential fraud. The report alleged that the Adani Group indulged in an accounting fraud and manipulation of stocks, a claim that has brought Adani down to his knees. After the release of the Hindenburg report, share prices of all of Adani Group's companies fell drastically, a rout that has continued for 6 straight days. The Adani Group has lost up to $108 billion in a matter of a week. At the moment, it is clear the Hindenburg report has opened the floodgates for the Adani Group to come clean on its balance sheet, and shrug off allegations. Now, let's go for the economic indicators. The euro area economy expanded 1.9% year-on-year in the last 3 months of 2022. The least since the COVID-induced contractions in 2020 and early 2021. Ireland recorded the biggest growth rate, 15.7%, followed by Portugal, 3.1%, Spain, 2.7%, and Austria, 2.7%. Considering full 2022, the Eurozone GDP expanded 3.5%. Germany's annual economic growth slowed to 1.1% in the fourth quarter of 2022. A preliminary estimate showed. Europe's largest economy was hit by rising interest rates, stubbornly high inflation, and supply chain bottlenecks. Annual inflation rate in the euro area fell to an 8-month low of 8.5% in January of 2023. The data for Germany inflation is not available yet. Inflation slowed in Italy, Ireland and the Netherlands, but edged higher in Spain and France. Also, core inflation, which excludes prices of energy, food, alcohol and tobacco, remained steady at 5.2%, adding to further evidence that price pressures remained elevated in the bloc's economy. Energy prices rose at a slower pace, 17.2% versus 25.5%, and services inflation also eased, 4.2% versus 4.4%, while cost increased faster for food, alcohol and tobacco and non-energy industrial goods. The euro area seasonally adjusted unemployment rate was 6.6% in December 2022, stable compared with November 2022. A year earlier, the jobless rate was higher at 7.0%. Meanwhile, the youth unemployment rate, measuring job seekers under 25 years old, was unchanged at 14.8%. Amongst the largest euro area economies, the highest jobless rates were recorded in Spain, 13.1%, Italy, 7.8%, and France, 7.1%, while the lowest rates were recorded in Germany, 2.9%. The ISM manufacturing PMI fell to 47.4 in January, the lowest since May 2020. The reading pointed to the third consecutive contraction in factory activity as companies slowed outputs to better match demand in the first half of 2023. Further declines were seen for new orders, production and backlogs of orders. The Supplier Deliveries Index indicated faster deliveries. The number of job openings in the United States increased to 11 million in December of 2022, the most in 5 months, and above market expectations. Over the month, the largest increases were in accommodation and food services, retail trade, and construction. Meanwhile, the number of hires and total separations changed little, at 6.2 million and 5.9 million, respectively. The ratio of openings to unemployed people rose to a near record high 1.9, if compared to 1.2 before the pandemic. On Wednesday, we had the so-awaited Federal Reserve Funds rate decision, which came in line with market expectations. The Fed raised the target range for the Fed funds rate by 25 basis points, now at 4.75%. This pushes the borrowing costs to the highest since 2007. Policymakers added that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2%. During the regular press conference, Chair Powell reinforced the disinflation process is on an early stage and that interest rates are not yet at a sufficiently restrictive level. In determining the size of future rate increases, the committee will take into account the cumulative tightening of monetary policy, and economic and financial developments. The European Central Bank raised the interest rate on the main refinancing operations by 50 basis points, now reaching the 3% level. They pledged to deliver another 50 basis points rate hike at the next monetary policy meeting in March. The interest rates on the marginal lending facility and the deposit facility were also increased to 3.25% and 2.5%, respectively. The central bank has also reaffirmed it would stay the course in raising rates significantly at a steady pace to ensure a timely return of inflation to its 2% medium-term target. Moreover, officials announced the asset purchase program portfolio would decline by €15 billion per month on average, from the beginning of March, until the end of June 2023. Then, the subsequent pace of portfolio reduction will be determined over time. The unemployment rate in the U.S. inched lower to 3.4% in January 2023, the lowest level since May 1969, and below market expectations of 3.6%. The number of unemployed people declined by 28,000, to 5.69 million, and the number of employed increased by 894,000, to 160.1 million. Finally, the U.S. non-farm payrolls came out on Friday. The U.S. economy unexpectedly created 517,000 jobs in January of 2023, the most since July. In 2022, the average monthly gain was only 401,000 jobs. Job growth was widespread in January, led by gains in leisure and hospitality, professional and business services, and healthcare. There were also big revisions, with employment gains in November and December combined being 71,000 higher than previously reported. The January data continued to show a tight labor market, although some companies prepare for an economic slowdown, and the tech layoff continues. Now, a quick walk around the markets. WTI crude futures rose almost 2% to above $77 per barrel on Friday, recovering from an over 3-week low of $75 hit in the previous session. Upbeat U.S. economic data eased concerns about a looming U.S. recession, while lifting the outlook for demand. On the supply side, OPEC's crude production declined in January, given lower output from Saudi Arabia and Libya. Earlier this week, an OPEC Plus committee recommended keeping crude production steady, citing uncertainty about the impact of China's economic reopening and the latest sanctions on Russian supply. Still, the U.S. benchmark is down more than 3% this week, on track for a second consecutive weekly decline. U.S. natural gas futures bottomed around $2.50 per million British thermal units, the lowest level since April 2021. Warmer weather next week is expected to further impact the demand. At the same time, more supply is set to stay on the domestic market, as the Freeport LNG export facility in Texas restarted production, but it is still weeks away from producing significant amounts of LNG. The Dow closed more than 100 points lower on Friday. The S&P 500 dipped in negative territory, by 1%, and the Nasdaq 100 by 1.6%. On Friday, strong job reports might signal that the Fed will continue its tightening cycle, pushing rates above 5%. Traders also digested disappointing earning results from Alphabet, minus 2.7%, and Amazon, minus 8.4%. Apple rebounded from early losses and finished 2.4% higher. For the week, the Nasdaq 100 rallied 4.1%, a fifth consecutive weekly gain. Bitcoin traded at around $23,000 this Saturday, February 4th. Looking back, over the last 4 weeks, Bitcoin gained 38.5%. Over the last 12 months, its price fell by 44%. Gold dipped below the $1,900 mark on Friday, a level not seen in more than 3 weeks, pressured by a stronger dollar and a pickup in U.S. Treasury yields. On Friday, silver futures traded around the $23 per ounce level, not seen since mid-January. Still, projections of weak supply limited the fall, as COMEX inventories remained under pressure and LBMA stockpiles plunged amid outflows to India. After trading sideways until Wednesday, gold broke out above its recent consolidation level following the Fed's 0.25% rate increase on Wednesday. Thursday morning, gold rose briefly to $1,959.70 before falling back to $1,911. Given the recent price action, it could suggest that gold is temporarily overbought. But looking at open interest on COMEX, this is far from the case. Open interest is the total number of contracts outstanding between market participants, in this case in the COMEX market, a futures market. Looking at the managed money, this shows that while the gold price has increased significantly, net managed money positions have less so. Bearing in mind that the long-term average net long position is 110,000 contracts, currently gold is marginally oversold. Physical supplies are extremely tight, with central banks still buying. Some coins are in very short supply. Anecdotal evidence in London is that sovereigns are extremely scarce with some dealers sold out. In Germany, members of the public are buying gold in significant quantities as well. And deliveries on COMEX this week alone have reached 11,817 contracts, that is, 36.75 tons. We can conclude that while there could be some short-term downside in paper markets, with good solid underlying physical demand, gold appears to be in the early stages of a bullish move and any reaction in the price is likely to be very limited. If we regard gold as true money and dollars as fiat credit, we understand that gold is not in a bull market. It is the fiat dollar which is losing purchasing power. The interest rate decisions of the US and EU central banks didn't surprise. Economic indicators start showing more and more subtle signs of a slowing economy, although the labor markets continue tight. The scenarios of a soft landing versus a hard landing are still unclear and the effects of monetary policy tightening will only be seen later in the year. Investors need to be patient and cautious, a difficult combination. The earnings season is still not over, but some softening can be seen in earnings. Very optimistic growth projections for the near future must be taken with a grain of salt. We might not have a stock market crash, maybe only a slow adjustment of valuations as the year unfolds and waves of optimism and pessimism come and go. In the geopolitical front, namely in Ukraine, there is no end in sight for the conflict, and thoughts of an escalation of the conflict are disturbing, to say the least. Next week. In the U.S., earnings reports, Michigan consumer confidence, and trade balance data will take the spotlight. Also, the focus will be on central bank meetings in Australia and India and inflation data in Germany, China, Brazil, Mexico, Russia, and the Philippines. Have a nice week. If you enjoyed this video, don't forget to like and subscribe to this channel. The content of this video is for information and education purposes only. The viewer is advised to verify the information using the cited sources.